In today's segments, we'll begin with experts' view on the recent geopolitical tension and market turbulence. Tensions in Bangladesh and China are escalating and impacting the global markets and investor confidence. So, what strategies can investors use to protect their portfolios from the ensuing market volatility? Let's see what our experts think about this. We have Rishit Shah, QPFP and co-founder at Mega Gain with us.
Thank you so much for inviting me on your show. As far as Bangladesh is concerned, the textile industries which has presence in Bangladesh might get impacted a bit. But overall, as far as the markets are concerned across the world, I don't foresee to get corrected much, or they might get corrected a bit, because Bangladesh is a too small GDP for global markets to get impacted. Yeah, unless and until there's a major crisis which is happening over there. As far as China is concerned, China is one of the largest economies of the world. So any problems arising over there will have knee-jerk reaction across the world. But again, there can be volatility which might see for some time. But again, we have seen in past that whenever there is a global crisis or there is a war which happens, there is a volatility which we see approximately for 6 to 8 months. Then markets start considering that news, and we have seen in past that the markets turning around. So all in all, if I say about the global markets, we might see certain volatilities for a certain amount of time, but in the long run looks good. But at the same time, I'll say in case of any problems which happens in China, right now companies are following China plus one approach. So emerging countries like India can get benefit out of it. As far as how we should structure our portfolios, I'll say there will be 3 types of investors which might see. One is an investor who is having a goal or investment which has an horizon for more than 6 to 8 years time. So this kind of investor has to continue their investment as it is. They don't need to change anything unless and until they have a different risk appetite altogether. Then there'll be a second investor who has a risk appetite, who has goals which are coming in next 3 to 5 years time. So ideally, they should shift their small and mid-cap portfolio to a scheme which is a debt and equity mix, like multi-asset fund or a balance advantage fund or a equity hybrid fund. And for the investors who has a goal which is approaching next 1 or 2 years, they should start moving out of equity and come to a debt portion or non-related to equity assets, because equity can be very volatile in the short term and it can be very unpredictable. So all in all, if I say, the investors who has good risk appetite and who has a larger risk horizon, I rather suggest them to increase their investment, because we might see good amount of volatility in the coming future. Volatility will help you to get a lower NAV at a lower price share, which will help you in the future for your wealth creation. And for the people who cannot take that much of volatility, start moving out of small and mid caps and start moving to an asset which has a mixture of that equity gold altogether. So yeah, that's all about from my side. Thank you.
Thank you for sharing your insights.